All right, so let's begin. Stay invested for long to create wealth. You must have heard and read a lot of investment gurus and pundits say that. But what exactly is long term? Is long term different for each asset class? And how has various asset classes performed as per their definition of long term? Let's get into the details of this. I have with me Niranjan Avasthi, SVP and Head Products Marketing Digital Business at Edelweiss Mutual Fund. Niranjan, good evening and welcome to the show. Let's decode this funda of long term investment, okay? Because you need to stay invested for long in order to create wealth. Okay, we all understand the statement, but when it comes to implementing this in various types of investment instrument, what exactly would be the definition of long term?
Right. Thanks, Kavita, for having me. This definition of long term has been debated for long. And I've seen people when we are in a good market, especially for equity, when we are in a good market, last 3 years returns are very good. A lot of discussion is that long term is 3 years. Exactly reverse when we are in a bad market, when last 3 year returns are not good, then the long term definition shifts from 3 years to maybe 7 years and 10 years. So I've seen people shifting this definition right from 3 years to 10 years, depending where we are in the market and how the past returns are. But actually, technically speaking, for any asset class, a long-term period is defined as a period where the risks are commensurate or risks are slightly lower and the rewards are slightly higher for that period, which means is the probability of making negative returns for in that particular period is lower for that asset class, and that period becomes a long term. So for each asset class, technically we need to see how they have performed across cycles and across periods. Specifically, what are the instances where they have gone negative, and accordingly define long term for that particular asset class.
All right, Niranjan, one aspect of maybe playing the duration game or maybe aligning your investment horizon or your investment goal with a particular duration. What kind of a risk profile one has to assess and understand from an investor's point of view in order to be aligned with the right kind of investment product? I mean, that's the crucial planning that an investor needs to do from their end.
Absolutely. So once you figure out that it's basically a two-way process. First, you have to see for what period you want to invest. If you want to invest for maybe 10 years, now in 10 years, and what kind of risk you want to take on your capital. Once you get answer for these two questions, then you have to assess, okay, for 10 years, which is the asset class which fits in my risk return profile. So if you're investing for 10 years and you're okay to take risk or intermittent risk or volatility in the investments that you make, then maybe equity is the answer. If you're investing for 10 years, but you don't want to take risk on your capital, then maybe debt is an answer. Or you want to take a moderate call, then maybe a mix of debt and equity is the answer. So as you rightly said, assessing your own risk appetite, your own investment horizon, and then understanding the asset class and the risk. You have to marry all these three and then figure out which asset class is good for you. So everyone talks about like equity is good for 10 years, but is it good for you is an important question. And that answer will come when you assess your own risk appetite, how much you can risk your own capital, and what is the period of investment period that you are looking to invest.
Niranjan, one basic or a common mindset among investors is long-term and short-term time horizon is mainly dependent on the tax implication that's applied on the investment instrument. Is that the right way to look at it?
Not at all, Kavita, because we live in a world where till recently the taxation or the long-term capital gain tax for debt was 3 years, and for equity we know it is 1 year. So for equity to qualify for long term, it is 1 year. For debt, it was 3 years. Doesn't mean that 3 years is long term for debt and 1 year is long term for equity. It is probably the reverse. For equity, it is much more than 5, 7, or even 10 years. And debt, it could be even 2, 3 years, depending on which debt fund you are investing in. So definitely taxation is not the anchor or not the factor to decide for any asset class for that matter, whether it is gold, equity, or debt, that what is long term and what is short term.
Sure. So, Niranjan, let's talk about equity. You invest in equity maybe directly through shares and stocks, and then you also take a mutual fund route. Why, if you're going through a mutual fund route in equity, you need to stay invested for more than 3 years or more than 5 years, and why is just more than 1 year in shares or stocks? I mean, you can have a longer time horizon, but then obviously due to the tax implications or the tax liability, more than 1 year is long term.
Right. So, as you know, we discussed that to define long term for any asset class, you need to see 2-3 things. Let's see that for equity, right? And I'm talking about equity as an asset class because risk, whether it is direct or mutual fund, broadly it is same, because if markets go down, your portfolio also would go down, whether it is mutual fund or equity. To some extent, direct equity, depending on how you are concentrated, it could be more risky. But for equity as an asset class, let's see, if you see the risks of making negative returns in equity drastically goes down as you increase your investment period. For 1 year, the negative returns have been around 55%. 2008 1 year returns negative 55%. In 3 years, that number goes down to maybe roughly around double digit 15-20%. In 7 years, it is almost close to 0%. And in 10 years, the minimum returns is around 8-9%. On the other side, the maximum return in 1 year one could have made or one would have made is more than 100%. In 3 years, it is 20-25%. In 10 years, it is around 19%. Now, if you see the dispersion or the range between the returns, what you can make or what you can lose, is very high in 1 year, right from 100% positive to negative 55%. On 10 year or maybe 15 years, it is as low as 19% to 9%. And most importantly, it is on the positive side. So now from a risk perspective, if you stay invested in equity for a longer period of time, then the risk is lower versus the compared to volatility, and returns are slightly in the narrow range, which means your experience in equity over long term would be better. Now, basis that, 10-year is probably a period where you can define that as a long term for equities. The other point is, what is you invest in equity to do what? To beat inflation. Now, taking this example ahead, if you look at what is the probability of you beating maybe 10% returns in equity in long run, which is 10 15 years or 20 years or beyond 10 years, the probability is more than 85-90% that you will make more than 10% returns. If you take just inflation, maybe more than 7% returns, the probability of you making more than 7% returns is almost 99% or 100%, looking at the past returns, of course, in 10-year or 15-year period, which probably explains that for equity, whether you are investing in mutual funds or through mutual funds or direct equity, provided you are able to pick the right stock, the long term is basically somewhere around 10 years and beyond. We should not extrapolate short-term returns and define that this becomes a short-term because last 3-year returns are good. Because we have seen when the short-term returns are good, maybe 3 or 5-year returns are good, we probably borrow future returns and we are actually earning those returns today. But in future, from that point in time, the returns do normalize. So basis all these 2-3 factors, I believe 10-year is safely a period one can assume is a long term as far as equity is concerned.
All right, so we spoke about a lot of aspects, but then I also want to understand long term in terms of other asset classes. When you talk about gold and real estate, how can you play the duration game with these asset classes? Or it's not advisable to do that, because if you have an investment horizon, just stay put in it.
Right. See, for gold, again, people do look at gold as a safe asset class, but it is not. It has probably lesser volatility than equity, but it does have volatility. We have seen gold also, giving negative returns over a 3-year period. Today, as we speak, if you see, 10-year return of gold is around 6%, which is lower than the inflation, it is not beating inflation. So gold also as an asset class will have cycles. But even for gold, I think so, the long-term definition basis how we did for equity, it comes somewhere between 5 to 10 years because it has volatility and one should look at 5+ years. As far as real estate is concerned, it's a very different asset class. First of all, very few people are, or rather look at real estate as investments, or one should look rather real estate as an investment, because there are multiple things, how the liquidity is there, which area you are buying. So real estate investing is a bit complex. As far as long-term definition in real estate is concerned, I probably think it is much more or beyond 10 years. It is much higher than equity. That's my personal opinion.
All right, so it's very important to analyze what is your preferred time horizon, align it with the investment instrument that you want to invest in, figure out the short-term and long-term risk involved, and accordingly place it in your financial portfolio. Thank you so much, Niranjan, for being on the show and helping our viewers with this today. Thank you.
Thank you.
Let's dip into a short break, but then post that, let's help you making an exit strategy from a particular stock after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and today let's focus on stocks and having an exit strategy in your stocks or your stocks portfolio. What sectors should you be getting out of? Let's focus on this discussion today. I have with me Aditya Agarwala, Head of Research and Investment Invest for Edu. Aditya, hi, good evening and welcome to the show. So very often you're on the shows where you recommend stocks, but today let's talk about exiting a stock. Okay, so it's very important, first of all, for you to know the reason why you have bought a particular stock, for what time horizon, if at all you have a purpose or a goal aligned to it. Okay, but then there has to be a time when you have to take that call to come out of that particular investment. Okay, so what should be those criterias or parameters?
Good evening, Kavita, and thanks for having the show. Yes, I do recommend stocks most often, and while I recommend stocks, it is very important, as you mentioned, to know when to exit the stock. And it's important to exit the stock. Unless you exit the stock, you're not actually making money. So best time to create riches is only when you sell your shares, and money is only made when it's actually sold and it's transferred into your bank account. Notional gains are only good to look at, but unless and until you book profits, they are not your actual returns that you're making. So there are two methods, Kavita, which can be used to sell your stocks. One is a fundamental parameter and next is a technical parameter. Fundamental parameters can be very basic, like the company's future growth, if that is stagnating and there is no promising future developments that you see in the company, and the reasons for which you bought the company is unfortunately not performing the way you were looking at. And then there are opportunities in other pockets. There are green shoots seen in other sectors and stocks. So that is one criteria to look at to exit your stock. The stock can be in profits, the stock can be at loss. But yes, it is important to stick to the thesis which you had picked while picking the stock. And if that thesis is not standing true after a few quarters, it's important to relook at the stock. And if it's not standing true to itself, then it makes sense to exit. So that is the fundamental parameter that one should look at while exiting the stock. The second is a technical parameter as well. Now, often there is a argument and a debate that one should look at technicals, one should look at fundamentals. I believe one should look at both because both go hand in hand. And there are times when fundamental indicators are ahead and there are times when technical indicators are ahead. So it's also important to look at the chart setup of the stock that you have bought. Many a time what happens is we end up buying the stock at a peak only to find out that the stock is correcting from that point of time. It is just that the company is good, just that your entry point was wrong. So whenever you were sitting on decent gains, the stock prices have shot up significantly and they have reached extreme overbought levels. They look stretched. It's time to look at selling or at least booking some partial profits in that stock. And how do you understand that the prices have reached extreme stretched levels? There are several indicators which will tell you that the stock has reached extreme overbought levels. Look at the historical setup of those indicators. If the current setup is somewhere close to that, then it shows that it is sitting at extreme overbought levels. Then there will be a price correction which will follow that, and then the supports will break. Stocks will start to form lower highs, lower lows. A classic example, if I give you, was the recent case of Adani Ports. The stock gave phenomenal returns to its investors. But now, if you just believed in fundamentals and if you did not look at the technical setup of the stock, you would have not exited the stock at a very good price. You would have exited much lower. So both one should look at, and the technical parameters and the fundamental parameters. And when both are in conjunction and both go hand in hand, that is the time you stay invested. When any of the parameters suggest the reversal, you should actually look at exiting the stock or at least booking some partial profits and then revisit your thesis and then do a reanalysis of your portfolio and stocks that you have.
Right. Right. So, Aditya, let's focus on specific sectors, and I will also come down to specific stocks, but then this question is specifically about sectors which are not red hot for you and have already had their own run up. Their time is gone and you should be just exiting these sectors. And why?
I believe, Kavita, there are a whole host of sectors which have shot up too soon, and a whole host of stocks which have shot up too soon, just on the basis of few developments. Maybe those developments have not materialized on the ground yet, but the price action has been swift and very sharp. You should be a little cautious there and look to exit stocks there. And to start with, one sector that I have identified for our viewers today is the Nifty PSE index. Look at the way that the index has moved in last 3 years. Just this year, Kavita, the index is up 40% year to date from Jan till now, while most of your broader markets have not given any significant returns, be it the Nifty or the bank Nifty. So this is one index which has outperformed big time. They look little stretched. RSI is sitting at above 80 levels, and this is on the high time frame charts, Kavita, that I'm talking about. This is not even daily or intraday charts. This is a week, monthly development that I'm talking about. So these prices have sustained for a good 1 year, and last 3 years it has given phenomenal returns. So at current levels, RSI is indicating that the prices look little stretched. RSI sitting above 80 is not very normal for the index. It has done very few times in the past, and whenever it has done so, the minimum correction that is followed in the index is 15%, Kavita, and the maximum correction that is seen was somewhere around 55%. I'm not saying that the index will correct 50% or it will correct 15%, but the historical data suggests that whenever RSI reached above 80 levels, it's time to look at booking profits. There's no harm if you're sitting on good profits to at least book out profits. And markets have turned volatile. We know that as well. So it's good time to look at booking some profits in the Nifty PSE index. The next two indices are not actually sectoral indices, but they're broader markets. I believe Ekta broader markets are also too heated up at current levels, and one should look at booking some profits in the broader markets. And when I talk about broader markets, I'm talking about the mid cap and the small cap indices. Again, these indices have given phenomenal returns year to date and in the past year as well. And again, the technical setup do suggest that they are too stretched. RSI is again sitting at 85 levels on high time frame charts. These are not normal levels on a high time frame charts. These usually develop after years of or months of outperformance. Again, the correction can be swift, and before you know that the stocks have started correcting, you exit the stocks, you will witness a 15-20% easy correction on your stocks. So I'm not saying that exit completely, at least pay heed to the fact that correction is around the corner. Book out profits where you're sitting on decent gains in the mid cap and the small cap spaces. Trim your portfolio, sit on cash. There's no harm on sitting on cash. It's very important to know when not to put money rather than knowing when to put money. Because if you put money at the wrong point of time, the chances of you getting stuck at a higher level are very high. So this is a time when we are strongly recommending, at least in the broader market space, sit on cash, book profits, at least some 50-60% of your portfolio where sitting on decent gains, sit on cash. There's no harm, Kavita. So these are the three indices predominantly where I see some kind of I wouldn't call it a bubble, but yeah, a froth kind of a building up, and it's not a bad time to book profits in PSE index, the mid cap and the small cap end of the market.
All right. So, so keeping the same analysis, what kind of stocks do you think people should come out of? Because based on their fundamental reasons of investment, or maybe they have adopted a technical technique to it. But specific stocks, if you have on your radar, where an investor can make an exit strategy, or maybe start thinking of one, what would that be?
So Kavita, there are a whole host of stocks which have multifold in last few months or maybe few quarters. To begin with, they're the railway stocks top of the list. I understand that there are a lot of development happening in the railway space, and just ahead of the elections, there are a lot of projects which get assigned, and a lot of tenders will be floated. But again, look at the way all these railway stocks have shot up. You name it, RVNL, Railcon, Railtel. Barring IRCTC, I believe the whole host of railway stocks have shot up. And at current levels, if you are looking to enter, I would strongly caution you not to enter. If you're sitting on good gains, which could be easily in the range of 50-60%, it's not a bad time to trim down your exposure in railway stocks. I'm not saying that these stocks won't perform in the long run, but there's no harm in booking profits at current levels and looking to re-enter when the stocks have corrected, because the way these stocks go up, they correct also sharp, and you don't get a chance to exit in these stocks. So railway stocks are the first of the lot, which I'm recommending strongly to book for partial profits, or at least if you're looking to exit, you can look to exit there and look at re-entrance at lower levels. Second is your some of the PSE lots, names like REC, PFC. Look at the kind of moves that they have shown on the monthly setup. RSI is sitting at 85 odd levels, which the stocks have never seen in the past. And from these levels, it makes sense to book some profits. You can add a Coal India to it as well. Too sharp move. We have not seen this kind of an up move in Coal India for years. So now it's looking a little stretched as well. So PFC, REC, names like Coal India, it's not a bad time to look at booking some profits there. Then comes your defense and your shipyard stocks. Look at the way the names like HAL has shot up. And it looks like there are multiple negative divergences building up, Kavita. Though the defense sector is hot right now, and stocks can perform there in the long run. But again, you'll have to relook and rebalance your portfolio is what I would put it as. If your exposure is too high in these stocks, I would suggest trim down your exposure in these stocks, be a Musgao Dock or a Cochin Shipyard or a HAL. It's no harm in trimming down exposure in these stocks. They look a little stretched, and a correction is around the corner in these stocks. And then few PSU banks as well, which have recently outperformed. Could be a Bank of Baroda or a Union Bank or an Indian bank for that matter. All these smaller PSU lots, they have shot up in a short span of time, too much for them to sustain at these levels for the long run. So I believe these are some of the stocks, especially your railway stocks, PSU banks, PSE stocks, and some of the defense stocks. I believe it's prudent to book profits ahead of any correction kicking in on any of these names.
All right, great analysis. Thank you so much, Aditya, with that, for being on the show and helping our viewers in forming an exit strategy in a stock. Thank you.
Thank you so much.
All right, time for a quick break, but then post that, let's get your mutual fund portfolio queries answered by Shweta Rajani. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are a plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate to this maze? Today we have Shweta Rajani, Head Mutual Funds, Anand Rathi Wealth. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Hi, good evening, Shweta. Welcome to the show. And we have our first viewer, Rahul Sharma, on the phone line with us. Rahul, hi, good evening. Thank you so much for sending us your query.
Yeah, thank you.
Okay,
thank you
so...
for taking me.
All right, so tell me one thing. You want to know about various asset classes and their historic returns.
Right.
Right now, do you have any investment portfolio across these assets?
Yes, right now I'm investing in stocks and various mutual funds, but I'm a little, less enthusiastic in gold. So I just wanted to know,
Okay.
like, what is the historical returns of the gold, so that whether it would be a wise decision to, start investing in gold.
Okay, so based on historical return, you want to decide if you can invest in gold or not. Otherwise, you have a portfolio in equity, which is stocks and mutual funds.
I'm an active investor also. I mean, in stocks, also through mutual funds.
Okay. Okay, all right. So the concern is you want to have more returns than fixed deposit by
That
investing
is
in
right.
gold as well. Yeah?
True.
Okay. All right. Interesting question. But I hope you have adopted a strategy where you have aligned your goals and you have asset classes aligned accordingly with your financial goals.
Yes. I've already done that, but I just wanted to know that whether I just wanted to ensure that I'm not going anywhere wrong.
All right. You sending your portfolio would have been really helpful, at least the mutual fund portfolio. But then, because you don't have that information, let's just stick to what's been asked, Shweta, over here. So, as per the rule, when it comes to diversification, it's important that you are invested across asset classes. But how important it is to look at historic returns, especially for an asset class like gold, where in the long term we use it as hedge against inflation. It's also a safe haven. It is important to have gold, but in the right form, which could be investing through a sovereign gold bond or a gold fund or a gold ETF. How would you like to decode Rahul's mindset of looking at historic returns and then investing in gold?
Sure. Good evening, Kavita. Good evening, Rahul. So, coming to your question, of course, I will share what the past performance has been, but just 2, 3 points before that. Your investment decision cannot be solely based on the past return of an asset class or, for that matter, a security or a product. You need to evaluate the risk, liquidity, future potential of that investment, and then see, is it helping you to achieve your financial goal or no? So that should be your decision making point. Past return can be used as one reference point. It cannot be used as the sole decision making point. I'll first address your question. So if I look at equities, and if I break it up into what Nifty 50 would have delivered over the last 15 years, it's around 13.5%. If I come down to mid cap, small cap, those returns have been around 19-20%. If you talk about FD is giving you around 7.3, 7.5%. Gold 15-year return has been 9.5%. Debt funds would have been around 8%. If I look at real estate, and I'm looking at NHB index by RBI that gets published, it's a national housing index. That shows real estate return would have been 4%, but that's generic. Real estate depends from one property to another property, whether it's residential, commercial. So it may not give you a true picture. So that's the historical performance. One thing on gold, and Kavita also highlighted, it becomes important as to what is the form of investment. You have to understand that gold, while it's said to be a hedge against inflation, if you also check the volatility, which can be measured by standard deviation, the standard deviation of gold is very similar to equity. So while historically, it's assumed that gold and debt would be asset classes that you can use to bring down the risk of the portfolio, to bring down stability, to bring in stability and bring down the equity risk, gold may not always fulfill that criteria to your portfolio. So if I have to choose, between the two protection asset classes, gold and real estate, I would suggest you go for, between gold and debt, go in for debt. Looking at the current interest rate scenario, what you can expect from debt is anywhere between a range of 7.5%, right? Not looking at history, because your interest rate scenario was different at that point of time. So going forward, expectation should be from debt a 7.5, with minimal credit risk. So I'm talking about GSEC-like investments. If you talk of equity, the way we're seeing the economy growing, and where the corporate earnings are growing. From equity, you can expect, with Nifty 50 delivering somewhere around 11% return. So your portfolio, which would be a combination of funds, stocks, to easily give you around 14-15% kind of a return. That should be your return expectation from each of these asset classes. Have a good mix of equity, debt. You can easily avoid real estate, and gold would be my recommendation to you. And what proportion? It depends on what's the financial goal you have and what's the return you're targeting for your portfolio.
Right. In-depth explanation, Rahul. Is there anything else you want to ask Shweta?
Shweta really explained well. Thank you so much.
All the best. We move on, and next question, Shweta, for you is from Ahmed, Andhra Pradesh, and he has HDFC mid-cap opportunities, Kotak emerging equity, Parag Parikh flexi cap. He has Quant and Nippon small cap, and he's been investing via SIP, and the time horizon he's looking is actually 15 years.
Yes, Ahmed, I'd seen the question and the funds, what you're investing. As far as I remember, you've been investing 20,000 per month as an SIP. If you're looking at a horizon of around 15 years, this would easily take you to a value of 1.1 to 1.2 crores over this time horizon. So continue with your SIP, and I'm hoping it will help you achieve your goal. Coming to your schemes in specific, you have two mid-cap funds, Kotak and HDFC. They are good. You can continue with them. You have a Quant small cap. That's again a good fund. You can continue with. Two funds where I would suggest some changes. The Parag Parikh flexi cap fund. This fund has some portion of international exposure, but the way we are looking at Indian economy versus a lot of the global peers, Indian economy is poised to fare far better than a lot of these international equities. So invest in a fund which is pure domestic equity, right? So you can go in for an HDFC flexi cap. Second, on the Nippon small cap fund, this fund has been a good performer in past. However, today it has a size disadvantage. It's crossed 30,000 crores of AUM. If you see the underlying stock exposures going on increasing with each passing month, so that's a disadvantage to the fund. So I would suggest these two funds, something that you should exit from the portfolio. Instead, you can look at building in through the multi-cap route. So you can look at a Kotak multi-cap fund. You can bring in an SBI contra fund, a different style to your portfolio. And that will also bring in some market cap diversification.
Wonderful. Let's move on to our next viewer, Shweta, quickly. Dakshina's question, and she wants to invest in an ELSS fund, and she also wants to understand if a time horizon of 25, she is 25 years old and she wants to invest in an ELSS fund. Okay, so top ELSS recommendations, Shweta?
Dakshina, I'm just hoping that you're looking at ELSS only for that 150,000 rupees that has to go in every year to give you a ATC benefit. If that's the criteria, then you can go in for an HDFC tax saver. That's a good fund. You can go in for an SBI tax saver or a Mirai tax saver. And if your purpose is not ELSS, then my recommendation would be to go in for pure diversified funds where you don't have a 3-year lock-in. These funds have a 3-year lock-in.
Okay. Shweta, could you also explain whether you should be investing lump sum in an ELSS fund or via an SIP? Because there's a 3 years lock-in. One needs to keep in mind there'll be a lock-in for every SIP installment.
You're absolutely right, Kavita, that if you're investing in ELSS, right, because there's a 3-year lock-in, it's recommended that you put lump sum. Because if you do an SIP, what it means is that your last installment also has to stay for, a 3-year tenor. So your average investment holding period would not be 3 years, but it gets extended to somewhere around 3.5 years. So go in for a lump sum of a year.
All right, let's move on, and we'll take Somasri's question, and she wants to invest for her daughter and niece, and they are 2 and 8 years old respectively, and she wants to understand how much amount can she invest, and investment horizon long term, definitely. So we don't have a lot of details because we also wanted to understand as to what's the kind of amount she's comfortable with. But then, as small as 500 rupees, so much you can start your investment with. But I think, Shweta, you can help with the fund selection over here, and also help so much in understanding what's the kind of corpus she wants to accumulate and how, basis on that, she can decide her SIP amount.
Sure. So Mashri, I'll first talk about the investment corpus. If you're looking at 2 years and 8 years children, then you're roughly looking at around 15 years by the time they would reach their stage of higher education. If I look at the cost and I inflate it a little, you would probably need 25 lakhs for each child. So you'll need 50 lakhs for their education purpose over the next 15 years. So what you would need is an SIP of 8,000 rupees. To get to that 50 lakhs over the next 15 years. Talking about their marriage, because that would be another goal. I'm guessing you'll have 25 years approximately to reach that. Again, taking just a rough corpus of 50 lakhs that you may need, 25 lakhs for each child. Considering your investment horizon is 25 years, or 2,000 SIP that you do would help you get to that corpus. So if you can, then my recommendation would be to start with a 10,000 rupees per month of SIP. That will give you, put you in a comfortable position. What you can also do is, as and when you have money, go in for some lump sum investments too. Coming to funds, I would suggest that you have a portfolio which would be of 4-5 schemes at least to start off with. And then as your horizon, as your funds increase, you can also increase the number of funds to the portfolio. My fund recommendation to you here would be to go in for a quant active fund, an Aditya Birla small cap fund, an HDFC small cap, Kotak multi cap. Since you have a longer time horizon, you can have approximately 50% in mid and small to your portfolio, and these funds in an equal proportion will help you get there.
Mm-hmm. All right, with that, it's a wrap. Thank you so much, Shweta, for being on the show and helping our viewers with their financial portfolio queries. And time to sign off. But then before I end the show, on the auspicious occasion of Navratri, we at ET Now will make your portfolio shine brighter with top stock recommendations from Sanjeev Bhasin. Listen in to his top stock pick on day 6.
Navratri, a time of celebration, devotion and new beginnings. But this Navratri, we are adding a financial twist to the festivities. Each day of this auspicious Navratri, we are going to make your investment portfolio shine brighter with a special stock pick. With decades of experience, Sanjeev Bhasin has been a guiding light for countless investors, and he is here to unveil his 9 top stock picks, a Navratri gift of financial wisdom for all of us. Thank you so much, Mr. Bhasin, for joining us on ET Now on the special occasion of Navratri. All right, it's day 6 of Navratri and new stock pick coming in from Mr. Bhasin.
Yeah, so today's pick is a dark horse, and maybe a lot of people have lost money in this stock. But I am sticking my neck out that we cannot have a 2.5 play on telecom. That is Reliance and Bharti on one side and half of Idea. Idea has now stopped losing market share. It is going to gain as far as ARPUs go, as rates rise. Plus, there is a relook on their debt with AGR and other things being considered by the Supreme Court, which some of part means that you cannot have a 55,000 crore market cap on a company which is the third largest in the country. I can bet that Idea can be a very good takeover target, or there could be a strategic buyout. I think Idea is going to go to 22 to 25. So take a small punt. I think Idea can be a very, very big wealth creator if my call is correct. So 22 to 25 on Idea, betting on a doubling in the next 1 year.
Thank you so much, Mr. Bhasin, for joining us today on ET Now and sharing your top pick for Navratri with all of our viewers. And remember, viewers, 9 days, 9 gems, courtesies Mr. Sanjeev Bhasin. You cannot afford to miss this.
पानी से भरी